The power of bridge loans in business acquisition. Hello everyone, I'm Jerry Stewart, and welcome to my video on unlocking the power of bridge loans in business acquisition. I've seen firsthand how bridge loans can be invaluable strategic tools for companies seeking to expand through acquisitions. Acting swiftly to capitalize on opportunities is key for ambitious businesses. However, acquiring another company requires significant upfront capital, funds that may not be readily available. This is where bridge loans come into the picture. What are bridge loans and why are they important? A bridge loan is a short-term financing option that provides temporary liquidity to a business for the explicit purpose of acquisition. Unlike typical bank loans that can take months to secure, bridge loans can be funded in a matter of days or weeks. This accelerated timeline allows businesses to seize time-sensitive opportunities that might otherwise slip by. As Sun Tzu said, "Speed is the essence of war. Take advantage of the enemy's unpreparedness, travel by unexpected routes, and strike him where he has taken no precautions." Much like war, the world of business rewards decisive and strategic action. I found bridge loans to be invaluable in three key scenarios, covering the gap between current capital reserves and the upfront cash needed for an acquisition deal. This temporary liquidity gives businesses the capacity to acquire beyond their current financial limits, smoothing out longer-term financing from other sources like bank loans. Since the process of securing permanent financing can have delays, bridge loans help plug sudden liquidity crunches, enabling accelerated expansion by rapidly integrating newly acquired businesses. The interim cash flow facilitates faster growth of the expanded organization. Essentially, bridge loans provide the financial legs for businesses to swiftly run across the acquisition landscape and secure strategic wins. They are especially useful for small to mid-sized companies competing against slow-moving large corporations. Now I'll provide three powerful real-world examples of companies that have strategically utilized bridge loans to accomplish game-changing acquisitions. Success stories, demonstrating the strategic power of bridge loans. Case study. 1. Launching an industry leader. One standout example is the story of a small chain of flower shops that used bridge loans to ultimately become the floral industry giant it is today. In 2021, the CEO spotted an opportunity to acquire their struggling competitor and significantly expand their retail footprint for a reasonable valuation. However, she did not have sufficient capital on hand to finance this million-dollar acquisition. By utilizing a $750K bridge loan, the CEO was able to front the cash while they finalized additional funding through investors. This bridge financing allowed them to rapidly incorporate the 10 newly acquired flower shops into their operations. With this new capacity, this flower shop saw their annual profits rise by 40% within 2 years. This catalytic acquisition financed by a bridge loan converted this company from a local business to a budding national brand. Today, they are the fourth largest flower retailer in the country, all made possible by the strategic deployment of bridge financing. Case study 2. Surviving an economic crisis. Bridge loans have also allowed businesses to survive tough economic conditions by doubling down through strategic acquisitions. Consider an IT consulting firm that leveraged this tactic recently. As external funding was drying up, they acquired their struggling competitor at an opportunistic valuation using a bridge loan. By instantly integrating their competitor's client portfolio and niche expertise, they expanded their capabilities and capacity despite external economic challenges. This tactical acquisition, fueled by bridge financing, allowed them to withstand the economic turbulence and ultimately chart a path to becoming the thriving industry leader they are today. By acting strategically in a time of crisis, they emerged stronger than ever. Case study 3. Capitalizing on unique savings bridge loans have also enabled businesses to seize one-off acquisition opportunities that offer unique savings. For example, when a large insurance provider began selling regional subsidiaries due to internal restructuring, they leveraged bridge financing to acquire a subsidiary at a heavily discounted price. By harnessing bridge loans for this time-sensitive and value-driven opportunity, this company rapidly added over 50,000 new policyholders, a full one-third of their customer base at the time. And they achieved this scale-up in customers at half the typical customer acquisition cost for the insurance sector. Bridge financing in this case allowed them to capitalize on an unexpected opportunity and establish themselves firmly in new regional markets nationwide practically overnight. The agility and flexibility provided by bridge loans has been integral to the success of businesses big and small across every industry. The temporary liquidity fuels timely action, and in business, timing is everything when it comes to getting an edge over rivals. Key considerations for using bridge loans in acquisitions. It's important to carefully assess risks before jumping into bridge financing for acquisitions. Based on my decade as an advisor in this space, here are 4 key considerations. Costs. Analysis. Account for interest rates and all associated fees to determine the true long-term costs. Model cash flows comprehensively before deciding terms. Repayment plan. Have a clear repayment plan for retiring the bridge financing through follow-on funding rounds or payments from future earnings. Contingencies. Leave room for contingencies since operating conditions can change after acquisition. Stress. Test your financial assumptions before committing to reduce risk. Expert guidance. Seek guidance from a qualified financing expert. An external specialist can help objectively assess opportunities, navigate loan options, and de-risk the process. While bridge financing packs an undeniable strategic punch for acquisitions, it must be guided by sound planning, savvy financial management, and expert support. Summary and key takeaways. Bridge loans can provide businesses with invaluable strategic and financial leverage to rapidly capitalize on time-sensitive acquisition opportunities. By filling urgent liquidity needs, they fuel the capacity for decisive strategic action. Here are the 3 key takeaways from this video. Bridge loans fill urgent liquidity needs with temporary financing to enable accelerated business acquisitions. The strategic use of bridge loans provides a competitive edge by expediting business expansions before rivals can react. Careful financial planning and risk management is vital for the successful utilization of bridge financing. I hope this video clearly outlined how strategically deploying bridge loans can empower ambitious businesses to accomplish game-changing acquisitions. Please reach out if you have any other questions. I'd be glad to offer tailored strategic insights on M&A financing based on my decade of experience in this domain. Until next time, charge forth toward your acquisition goals fueled by the power of bridge financing. Call 888-653-0124 today, or click the link in the description to learn more and share your success story.